All
Back
right.
again.
Welcome back.
Welcome back, everybody. Let's start out with the market. I got a chart of the Qs up because last night Google basically won their antitrust case. That's helping Google and Apple. Qs actually had an undercut rally at the 50-day yesterday. I didn't notice that until this morning. Popping up a little bit. We are way off the highs, though. This actually sort of looks like the type of market that goes green to red. I mean, we'll see. Small caps are down today. That everyone's tripping over themselves to try to recommend small caps. I mean, as I said in the newsletter this morning, I think the Russell 2000 is a crappy index. I would never buy IWM and hold it. I know, Jeremy, you trade TNA, but the key thing is you're trading it. So we're still toppy here. We'll see how today goes. Jobs number on Friday. Broadcom earnings tomorrow. I think I'm going to be on Schwab Network talking about it tomorrow morning. I think Broadcom, along with NVIDIA, is a must own. One of the things I'm going to say is I think it's going to be hard for them after what we saw with Marvell and NVIDIA earnings to really move the needle. I'm thinking there could be a buy on weakness type of thing, but I mean, earnings are a crapshoot. I wouldn't trade earnings. That's just my thinking, and I'm hoping. I mean, I'd love to buy more Broadcom on some weakness. So that's what I'm seeing. Nothing too exciting at the moment. What about you, Jeremy?
Yeah, kind of the same. The old let's just scalp it in range until it breaks. As far as Nvidia goes, yeah, I think I had a target at like 185 on it. I didn't quite make it, but it's close enough, and it's always wise to kind of be a little bit cautious going into earnings. I never like to hold anything over an earnings call unless it's like sell to open options. And then there's QQQ, and I'm glad you got that chart up. If you wouldn't mind throwing a 2 or 4 hour up though, 2 or 4, whichever. I've been talking about this pattern I've seen develop many, many times over. And at the top of a bull trend like this, you can see we've got broadening range, and then it goes into contracting range. I call it the diamond pattern, and typically they precede volatility. Well, we're getting pretty close to the end of that. We've got jobs coming out Friday. We had jolts today, and it's just trading within range, bouncing off of the angular resistance and support. I mean, you don't even have to draw. You can see it right there in the chart. So looking for a break anytime between the end of this week and possibly into about the 10th or 11th next week. There might be something ready to give us a big move. So we just scalp the range in between then. I love to use QQQ to do all of my charting because, well, I get really good drawing tools on my Webull platform, and they're really quick. And then I'll scalp the NQ with it. So I've always paid very close attention to all the technicals on QQQ, and it's looking like we're just waiting for something here. I just can't wait. I think we're gonna have some excitement, but in the meantime, we've got lots of equities we can scalp and trade in the meantime, and kind of let the shoe drop.
Okay.
Pat, before you introduce Larry, let me preface. So, and I've told this story before. What really one of the big things that got me into trading, and really brought me to where I am now on trading and investing, were Jack Schwager's Market Wizards books. I don't know how many he's got at this point, but I started reading those in the early 90s. And while all of the strategies that are in there are now basically obsolete, I would still highly recommend reading those books where he profiles the top traders at the time, who were people who were generating massive returns outside of things that Wall Street recommends, like asset allocation, 60-40 portfolio, all of that. And Larry Benedict, who we have on, is one of the remaining still alive and still in the business.
Still alive.
Yeah, still alive, but also still in the business.
He's
I'm
got
sure.
the best hair of all of us, bro.
Yeah.
Oh yeah. So
I appreciate that.
one of the market wizards out there. So we're happy to have him on this call.
All right.
Appreciate it.
All right, Jess. So Larry's, I think, was in Hedge Fund Wizards, Chapter 3, right below Ray Dalio in Chapter 2. So that's a pretty good spot. All right.
Yeah.
All right. So I don't know what else to say. Larry's also the manager of one of our new funds. I think came out June 25th, the Opportunistic Trader Fund, symbol WZRD. If I'm correct, it was priced at 25.
Now you understand the symbol wizard.
Now I think it's at 26.40 or 50 or something, up like, I don't know. I can't remember the number enough though in the last month or so.
2681.
26.81. So I mean, it's doing something good. Larry, what's up, man? How you doing?
You know what? I think, I don't know if you want to hear a little bit, quick 2 second on my background. I've been doing it for 40 years. I know it, went by pretty quick. And, I have experience really in the global macro space, but really in options. And this fund, this ETF, is designed to use all of my best strategies that I've used for years, um, you know, putting forth the view using mostly options. And what people should understand that are watching here is the volume in options has exploded. It so dwarfs equities right now that it's incredible. They have zero DTEs, which are options that expire daily on indices, and for equities, it's once a week. When I had my hedge fund, Banyan Equity Management, for a number of years, um, we had about $1 billion under management, and we only got to trade those expirations once a month, the third Friday. And now everybody is using these tools in what I believe is not the right way. It took me years and years and years to understand how to price options, values, volatility, all the Greeks, etc. And now we got every single person trading these things, off their phone. And I hate to use the word in the business, but gambling. And that's given my fund and my ETF the opportunity to really have edge. And I think we have built in edge. And although we're not paying a dividend, I would qualify this as a yield enhancement product where we're chopping yield out of the market literally on a daily basis. So I think it's a unique strategy. It touches mostly on indexes. We trade top equities as well, but it's really expressing a macro view. And as Matt knows, we're actively traded almost to the day. So we're trading this vehicle every single day, almost the way, Jeremy, you described, like scalping QQQ. I mean, we're able to add alpha scalping in this product. So I feel really, really good about this.
So, Larry, most people, their experience with ETFs are, index-based things where it's just, hey, we're tracking the S&P, we're tracking the NASDAQ, or active things like, Kathy Wood, we're buying stocks of, innovative companies, that type of deal. Long only, market has to go up for them to make money. If the market goes down, they lose money. Explain your strategy. How are you different than just kind of long only directional stuff?
Sure. It's interesting because I think people kind of need to know about this because we'll utilize different strategies all throughout a month. If we think it's the right time to be long equities and short calls, like a JP Morgan Jippy strategy, we may do that. But when we think the market may crack, we'll stay away from that. But really, the way I look at it is, we have a pretty correlated beta to the S&P 500 underperform if that index does very, very well, but kind of correlate to that. But really, the kicker here is by using a lot of the strategies that I have, we should make money on the downside. And throughout my career, whether it was 1987 or 2000 or '08 or COVID, those are very positive years for me. So that's where I think this strategy, we hedge the downside, we hedge our exposures, we use defined risk strategies, but we have the ability to have the downside pretty much covered. And what's great about this strategy is it trades a lot, and as volatility goes up, it just creates really, really good opportunities for us to make money. So I would say if someone's looking at this strategy, we're using, almost like a hedge fund type strategy, macro thematic, yield enhancing, defined risk outcome type of stuff. But we're always, leery of the downside, and we've always been able to capitalize when that happens. So, I think it's
So let's talk more about the downside part. So we teach people something, and viewers have heard this a million times, called the heat formula.
Excuse me.
And the H stands for hedges. And, I'm a big believer that you should always have hedges, that bonds are not a hedge. And I mean, yesterday was a great example of that. Stocks went down and bonds went down at the same time. And I think options are perfect for hedging because they're just so flexible. So how specifically do you guys kind of manage that downside risk?
Well, what we do is we never sell naked options. Okay. I don't believe in it. I've watched people lose all their money by doing that. So all of the stuff that we're doing, so we may sell a call spread, and then we may take that money if we're really bearish and then buy a put, or, basically have under the market, protection. So that's sort of how we do it. And we're able to get what they call an options gamma from these positions. So as the downside kicks in, our deltas kick up and our positions become much, much bigger. And what people are discovering, I believe, and especially the retail clientele, is how much leverage inherent you get from options, if you think about it, right? So if you buy one call or one put, you're controlling 100 shares, and that 100 shares could be of a $600 stock for $300. So options really give you an inherent leverage. So we do a lot of hedging, and then we have downside protection that we finance by our trading, and that's how we're able to capture the downside.
Let's get more into something you just mentioned about delta expanding, because I think that's really important. So like in my personal portfolio, when we're designing an ETF called ONO, which is designed to be no bleed tail risk, one of the cool things about options in my mind is you get kind of that delta expansion. So during Liberation Day, for example, I mean, my base case is I like to have on a delta adjusted basis, 10% of my portfolio hedged. But during Liberation Day, the market went down so fast and volatility went up so much that my 10% hedge expanded. I don't know what it expanded to, but I mean, I was making money on those days because, my VIX calls and all that stuff expanded so much. The gains outweighed the losses on my long positions, which is something I love about options. You want to go into a little more detail on that?
Sure. So what happens is, especially like look at your base case, you only had 10% of your exposure hedged, but that 10% between the expansion in pure delta and the gamma of the position plus the increase in volatility gave you over 100% hedged position, right? I mean, you were probably making money, so let's say you had 400 puts that you had, or whatever the number was. Those puts gave you so much expansion that it covered your your loss on your long portfolio because of the movement of the delta of the option. So you might have bought, you know, 10 delta options that expanded to over, like literally over 100 delta. And we saw that a lot during the 1987 market crash. I actually stood on the floor during the crash of 1987, and I'll never forget it. I was short a straddle, which is being short an at the money put and an at the money call. And I remember I was young. So I was 25 years old, and I called up my boss and I said, we're short, 10 of these puts, and they're $80. And the guy was like, listen, stay on the bid. I ended up, I bought them back. They went to $700. They went to almost a higher price than if the index went to zero, because the volatility went to basically 800. So that's the beauty of having that downside hedge. And it doesn't come into play a lot, but when it does, it gives you an unbelievable hedge and the ability to make money. And, if you go to my hedge fund, Banyan Equity Management, in 2008, which was obviously one of the worst years on record, we were able to make 18% net to investors on $1 billion when the market fell apart. And a lot of that was what we talked about here, which we're going to use in the Opportunistic Trader ETF. The wizard is these hedge type of strategies. So we're just getting alpha every day, and we're adding, it's just risk management, and then utilizing that risk management to spend money to buy hedges.
One other key point I think you brought up, or a key trading strategy, you talked about doing a call credit spread and then using that credit to buy puts. And I love that strategy, because if you're wrong, you don't lose any money. And if you're right, you have unlimited upside. Um, and I think that is something I don't see anybody really talking about. You want to go into that a little bit more?
Sure, Matt. Yeah, you would lose money on the call spread. Let's make it up. Let's say the index is trading at 60 for 30. You sell the 60 for 50, 70 call spread at 20-point wide. You collect $4 for that. You can lose $16, okay? But you're utilizing that money and you're spending it on puts. The only way that I believe that you do those trades is when you're bearish the market,
Right.
but you want to make sure, that you're hedged on the upside. So it gives you a defined risk hedge. You take that money and then you buy a put, and then you have the ability to make on your call spread the money you spent on your put, and you own that put for free. It's one of the strategies that we use. We use a number of different strategies as well to to either have defined risk or know that we're not spending a lot of money on options. We generally want to be short, not options naked, but short credit spreads, across the board, and then trade around that and utilize the money from those trades to either buy puts or put spreads. And, You touched a little bit on the markets here. I think we're at we're end of the summer, critical juncture. I just want to say that for me, looking at the action in NASDAQ last week, where we dropped midweek 1,000 points in 2 days, and I had every friend of mine freaking out, even though they were up a ton of money. It makes me a little leery here moving forward. And I do think that there's a trade out there that people need to look at. And it's people are right now, big hedgies are short front end volatility and long back end in a big way. And that's starting to come off. And when that comes off, it creates selling in the marketplace. So I would just keep an eye on that because they've been pounding front month volatility all summer and buying back end. Like if you look out, 4, 6 months, we're at like a 25 vol. And the front month got down to like 14. So yesterday we ticked almost 20, but that to me is a critical thing to look at.
That's interesting. Would you, in that case, do the opposite? Short the back month and buy the front month?
I wouldn't do that, but I would look to maybe get long the front month. Yesterday we spiked almost 20% in volatility in one day with only a 1.5% down move on the S&P, which listen,
Notice
we haven't seen a 1.5% down move in the S&P in a long time. I saw on my screen the SPO was down 100. I was almost getting happy that, things were getting back, but they reversed that. But, I think potentially vol at 18 is too low relative. So I would kind of want to buy that. I mean, you can sell the back end, but you're not going to make as much on the trade, and it kind of makes the trade difficult, because you got to get out of two legs. But I kind of like that trade. I think that's interesting. I think there's a lot of stuff in macro that's starting to really click in. I mean, the oil trade today, kind of reversed, and there's a lot of stuff. I mean, I think you guys are seeing it too. I'd be interested to know what you guys think, of the
Can I
market.
cut in here? So let's go back to Wizard, right? Can you pull that up, Matt, or are you not? We're not allowed to. We can, right?
It's a chart.
All right. Okay. So, like, this is your strategy is you own a lot of treasuries. You own like I just pulled this up. Could be old 65% T-bills. 30% 20-year TLT. Yeah.
Yeah, we're in that, but
Okay, so I mean, just so everyone listening is clear, so you take a big treasury position and then you put 10% in options positions or some type of more of a leverage trade, yeah.
yeah, but you got to realize with options, I'm getting so much inherent leverage. I mean, if you pull down to my file, I mean, we have very large positions on index that expire pretty much today. So we're doing like a zero DTE type of strategy, but we're not doing it. We're doing it for one day. So it's not 0 day, it's really a 1 day. And we're continuing to roll that strategy as we go. And we're able to put on really good exposure in these strategies, not using a lot of capital, and we're net short, basically spreads. So we have massive, credit. We're running massive credit spreads.
Got
As
it.
And Pat, let me clarify on that, because that is a very important point. And it's something we do. I mean, something I do personally. We touch on it here. The beauty of options is a couple of things. First, it's an asymmetrical trade when you're long options because you've got a known downside and unlimited upside. But the leverage component is key because, like Larry had said, one call contract allows you to basically control 100 shares of an underlying. So what I do is, because my portfolio is almost entirely options, I use the options Greeks, specifically delta, to come up with, a dollar amount of equity exposure. And then I can tailor that how I want. Me being pretty conservative, I'm not personally that exposed, but the beauty of the heat formula is you can ramp it up and ramp it down based on taste. In the market at highs, again, I'm not that exposed, but then that allows you to use that cash. So my portfolio personally, it's like 80 to 85% T-bills, but I could still, if I wanted to, have 100% equity exposure and, have 70, 80% of the portfolio in T-bills. And to me, the beauty of that is if everything blows up in my face and every single one of my options goes to zero, which highly unlikely, I've got, max 20% downside versus like a 2008 where you could lose or where you did lose 60%.
Right.
So I think, when you're looking at option-based ETFs, you want to focus on the options and you want to focus on the delta, not as much, where they're sitting on their cash.
Got it.
And
Okay.
what I would like to add is when I had my hedge fund, which had over $1 billion under management, I would tell you we probably had, I would say, 800 million in treasuries. We never, because I was trading mostly futures, which is massive leverage,
Yeah.
and options. So even though we had the 1+ billion, I just looked at it that I had $1 billion and I knew if I wanted to obviously make 10% on the year, I had to make $100 million, and I did not need that money. That money was good for me at the time because it smoothed my return. When if I ran that with
Got
$200
it.
million, my volatility would be 5 times what it is. And people like the fact, that we went, I would say, 15 years without a 3% drawdown, peak to trough. So
Right.
it was a very steady, grinded up, strategy for many years. And what I found here, and the reason why I really love what I'm doing with Wizard, is now I'm giving the retail public the opportunity to buy a hedge fund type strategy for, for very low fees with total liquidity that they can get in and out whenever they want. So that's
Well, what one caveat I'd put on that is a non-correlated real hedge fund strategy. I would argue a lot of hedge funds right now are just leverage beta.
Yep.
And, so a real solid old time alternative, non-correlated type of thing.
So I just did a scan earlier yesterday or something about the top holdings of the fund. I mean, can someone derive anything from this? Like if you were along the Palantir puts and the QQQs and all that, this is old information, or is there anything to derive here?
We're not in those, we're in different positions than what you're seeing. Palantir, we're actually out of the name right now.
Right.
But
Same.
what you would see what you would see generally in the ETF is you would see top 50 stocks on the board, going where there's opportunity. That's why we're the opportunistic trader.
Right.
And we may trade Palantir for a month and then not trade it for 6 months. So we're not going to go to illiquid stuff that we're sitting in. We're not, making concentrated bets on anything. We're just going where the action is. You may see a position in Apple today, because there's been a lot of news in Apple. And we're in everything that's really tangible. And then around that we're running an index hedge. So That's what we're doing here.
So now let's say, so hold on. So Apple, up 2.57%. We mentioned they're benefiting from the Google news. How would you, the normal guy who's, would say, hey, I'm going to buy 100 shares of Apple. The option guy, normal guy would, hey, I'm going to buy some Apple calls. How would you guys express an opinion on Apple?
That's a great question. So the first thing would be, I have two analysts that work with me. We would go over some technicals. We would, obviously parse out the news, but it would all depend on how bullish or bearish I was on the stock or the scenario. So if I'm truly really bullish, I would buy outright calls.
Okay.
Okay. That's the best way to play it. You get the leverage. I don't love to do it. It's rare that you'll see that, but sometimes I do that. But we may, express our view bullish by selling a put spread below the market, saying, hey, Apple's trading at 238. If it gets back down to 235, we don't mind owning it. So we may sell the 235, 225 put spread where we have defined risk of the $10 spread, but we're able to take in premium or money on that position. So that would be another potential way to play it. And then there's what we discussed before where we may sell, a put spread to buy an outright call or an outright call spread. So there's a number of different strategies that we use, all kind of similar almost all the time, but we we have to assess the view that we have on the stock.
So let's say, you were fairly bullish. Let's say you wanted to do a put spread. So you would never do, cash secured, just naked put. You're all right. So
You
you're
know
always
what?
right.
You can do that, and I know a lot of people do that. It's just that I've seen so many things out there happen that I always want to have it protected.
Got
So
it.
we really don't write naked options. Now, listen, we may sell an Apple 245 put and buy a 210 put. So obviously, if Apple goes down to 220, we're pretty crushed, but we at least know that the bleeding will stop at a certain level. And I think it's important. I've managed a lot of traders in my career and I've seen a lot of things. And that's, the panic, when panic sets in with traders, that's where the problem is. So I want to not be in a position where we're fully panicking. And I think when you sell naked, like everyone, I have a friend in my community and he's not even in the business, but he sells naked puts all day long because he's like, oh, if I buy Meta at 680, I'm fine. And, he says that until the world falls apart like '08. And he's going to take delivery and not have the cash to pay for all the stocks. So,
Yeah.
we don't like to sell naked, but it is definitely a strategy that's out there that a lot of people do use.
Can
And
I ask
so
you a more open-ended question? Oh, go ahead, Matt. Sorry.
yeah, if you're writing a put spread here, like, a lot of times, like if someone was doing naked, the obvious places to put it would be, 220, which is right under the 200-day, 216 or 215, let's say, right under the 50. It sounds like you're more writing, the one you're selling is around the money.
Yeah, it would depend on the view, but yeah, closer, definitely closer to the money. And the hedge side, up where you're talking about, so that's where the hedge comes in. Because if it doesn't hold the 50 or, the moving average, we want to make
Then
sure
you
that
want
we're
protection.
protected there, so yeah, a lot of that stuff. I mean, and a lot of trading in our strategy. We're doing anywhere from, I don't know, I would say 20 to 50 trades a day potentially in this, which is unique to the ETF space for sure.
Right, which answers your question, Pat. you can look at the holdings, but you don't know
Right.
what they're doing today. You're looking, at what they were thinking yesterday. And again, because there are a lot of spreads and things like that, if you're not really cognizant of options, you're going to have a tough time trying to discern. And then also, I mean, you've got some bullish stuff, but like Larry said, there's an index hedge. So you'd almost, really, if you wanted to get a sense, you'd want to look at the delta, because the index hedge could be hedging, you could be net short, it's hard.
Okay, this leads to the question I was going to ask, which was, I'm on Twitter a lot, whatever. And someone's going to post something that says, "Oh, a whale just bought 100,000 zero DTE calls expiring yesterday, and they're gonna, blah blah blah." Can you read anything into that? I mean, can you, some massive option position, because it's out there all the time.
Yeah, a lot of that might be us. But
Oh,
And
okay.
normally that's buy to close,
So,
Pat.
so that's a yes or no. That's like that's the secret sauce, as they
Yeah.
say.
You know, I don't love that stuff. And the reason why I don't like, I mean, I know people use it and all of that, because a lot of times when you call it like a whale or whatever, that could be a big, big hedge fund, and they could be, hedging exposure. They may, like some guy might buy, I'm making it up, 200,000 puts in an index or whatever, but the guy may be massive, his book may be massively long, and in reality he wants to rip those up and throw those in the garbage, because if they do go in the money, he's not making money. So
Right.
sometimes that does work, and I think it does work a lot more in individual names than it does in indices. It's way, way harder to move an index. But if you see it, let's say XYZ is buying, 100,000 Palantir calls or whatever, that is more apt to move a stock than the broad market. So if you're seeing like index flow, Q, SPY, SPX, I don't put a lot of relevance in that, but I definitely think, and you saw it during during the beginning of the meme phase, the amount of buying and out of the money calls in GameStop literally was the most unbelievable thing we ever saw in trading at the time, and that literally what we call gammatized everybody, where we talked about earlier, change in delta, you know, big hedge funds, Citadel being one of them, was short so much gamma that they almost had to stop trading, and they stopped people from buying more. I don't know if you remember, but
Yep.
Yeah, I do actually.
pre-opening. So yeah, you can read a lot, and there are a lot of, I don't know if there are ETFs that are doing it, but I know there's a lot of scanners, because sometimes when I come in with volume, we'll see
Right.
volume right behind me. Like, so I'll
Right.
buy X, and then right behind me is a trade, and I'm thinking, who is that? But it's actually an algorithm that's sniffing volume. And they're like, oh,
Right.
wow, we just saw it. It's exactly what you just talked about. It's out there. Wow, this contract traded 50,000 contracts. Something must be going on. And every time we see 50,000 trade on a contract line, we want to be long it. So yeah,
Right.
there's a lot of stuff out there like that for sure. But on the index side, I wouldn't put a lot of credence in it, but on the individual equity side, definitely, it definitely comes into play in a big way.
Good.
Pat, where I would look at that as a couple of things. I would not look at unusual options activity on its own. If you've got a stock you like, and you've got a guy, especially what I like to look at is like short term, out of the money stuff. Like, if Apple's at 235, if someone's buying an Apple 250, a ton of Apple 250 calls that expire on Friday, that's interesting, because those are only in the money if Apple moves up another 15 points. But for me to take that trade, I'd have to like Apple.
Right.
There, it also is helpful. So, I mean, insider trading is rampant.
Right.
And if you are insider trading, you're probably trading in the options market. So when you see something really unique, and you're not going to see it in an Apple, but like, some name you've never really heard of that hardly trades options,
Yep.
and someone just bought $2 million of, contracts, 10% above where it's trading now, that expire on Friday, there's a halfway decent chance that person knows something.
Right.
And so, that's a situation where maybe you just say, you know what, I'm going to take a flyer. I don't know.
Right.
And, I've done that before where you just see, you're like, somebody knows something. I'm just going to buy some calls and see
How'd that work out?
The lotto trade.
I mean, I've definitely made money but I've also lost money doing that as well. I had one where, the guy was actually right directionally, but wrong on timing.
Right. Story of my life.
I trailed his options. I lost money. Then 3 weeks later, the stock got taken over. Crap.
Right.
Your inside
Yeah.
information is bad, man. Whoever you were.
Right.
I would also say something that's very interesting that we look at a lot, okay, is the skew on the option chain. So
No one
like
mentions
All
that.
right. Yeah.
let's
Listen.
talk about Nvidia into earnings. So Nvidia into
Are you able
earnings.
to pull up an options chain, Matt, on here?
No, but that's
No?
all right.
All right.
Yeah, but what I wanted to express is so usually, since I've been trading, puts always trade higher than calls just because of uncertainty. But what was interesting, what we picked up on in Nvidia was the calls were trading significantly higher than the puts. So it's almost like what Matt said, like everybody was skewed so bullish that it created. That's probably why the stock didn't go up so much, because the amount of call buying was exponentially bigger than puts. So, we watch a lot of that stuff too. We'll watch volumes, on different strikes, and again, what Matt said before is interesting. Like, if you see unusual activity, you could not even buy that strike. You may think it's even better, and rather than buy
Right.
the Apple 260s, which are, like you said, the flyer, you may want to buy 245s that are in the money or at the money, buy way less, and then just chip it out. That's like
Right.
what we do. Just buy it, capture the move in a day or two and be gone. Because a lot of times what happened to Matt on the one trade happens to us. We just run out of time, or the move doesn't happen quick enough, and the decay is just very, very large. So
Right.
And it decays even faster on indexes, by the way.
I got another one. I'm going to come out of left field with you, Larry, here, right? So we were talking earlier, there's this chart floating around that shows CMBS defaults at like 11.5%, all-time highs. I think you're in Boca, right? I used to live there. We had a
yes.
guy, we had our FAU professor on Rebel Cole. He's like the leading, skies falling on CMBS guy. I like him. He's very smart, does a lot of good stuff. You have any thoughts on any of that?
You know what? I don't play that a lot, but I will say, I won't mention names, but I have someone that I'm close friends with who's probably the largest M&A attorney in the United States. And, we were just chatting, and he like was questioning, the debt down the line, and he was asking me for, what I think to structure a trade for, default, which, listen, I don't, it's a flyer and it's a nothing, but it's an interesting thought, that people are looking at this kind of stuff. And I do, listen, I do think there's a lot of bad deals around. I don't know how it plays out, but yeah, I mean, I'll look at that, but that's not going to impact me,
Right.
on a day over day basis. But
Got
for sure, I do think that, it could come into play here.
Okay. Any thoughts on crypto and all that? I mean, I think it's pretty stretched, but any thoughts yourself?
Yeah, we have position short crypto, and if you look at my file tonight, it could look interesting.
I see.
Listen, I think I was surprised coming out of the weekend. We're traded at 107 on Sunday, that we're back at 111 plus. I really thought it was in danger of ticking 100,000 or less. I think, listen, with the advent of all these new ETFs and new ways for people to buy crypto without actually buying the coins, buying, IBIT or any of these ETFs, I think that the market doesn't understand, crypto has become mainstream, but really, I've looked at crypto, since it was under 1,000. And the funny thing is, I would have bought it down there for a flyer, but it was just weird. I couldn't buy it in a brokerage account. I had a guy come over and, said we could buy it on this zip drive, and I just,
Right. That's what Matt says too,
no,
right?
knowing me, I would have lost the thing. I would have been one of those stories, right? It
Yep.
would have been like, Larry lost this damn thing. Where did he put it? But, I
Right.
didn't buy it. But the truth is, if it was able to be bought in a true brokerage account, I would have bought it
Right.
100%. Just as, for a trade. But, I think there's downside here. I think everybody's long it, and if it gets down to those levels, it could get people frustrated. And then you got Michael Saylor. I don't know what his pain level is on his financing, but you talk about, the financing part. I mean, he's financing all these trades, so we'll see what that number is.
Right.
And then the better question is that I have for people out there, how many people have lived through one crypto winter? I mean, I remember hearing,
Right.
crypto winter, oh, you did?
That was fun.
How long of a winter was that?
There was a lot of crypto winters. I don't know. They haven't been
Yeah.
in a while, but I mean, I remember businesses starting and then basically getting out of the business because, crypto had no bid. And, if you go back, it's interesting. If you go back to COVID, um, the beginning of COVID, crypto traded under 2,000, which is pretty unbelievable. Then it exploded up, but it got back down. So again, I'm negative on crypto. I think it's being held up by flows, but I'm hoping that it gets down into the 100,000 area so that, it can start trading with a little bit of volatility.
How
Got it.
how would you express a trade like that if you were negative? Would it be a call credit spread? Would it be outright puts?
We're selling, we're selling call spreads because I'm not fully convinced of that move. Once we get into what I call the hole, like at 105, 106, we'll get more aggressive, maybe buy puts. But right now, it's kind of like, hey, I don't mind being shorted at 113, 114. But once it gets down and we see a little bit of momentum, we'll get a little bit more aggressive on that trade moving forward. But for right now, like I said, I thought on Sunday night coming into Monday that it would have really given us a bigger push, but it didn't. So, I'm kind of sitting I'm getting in it, but I'm not getting in it overly aggressively.
Well, and the beauty of a call credit spread, depending on where you write the call, is, I mean, crypto or Bitcoin has been basically, kind of in a zone. If it goes nowhere, you still win on the trade because your call decays every single day.
And that's the beauty of the strategies that we run, for the Wizard, is we're collecting decay every single day. And then what's happened that's made this really, really good for me is the other day, I mean, they're trading 50 million contracts in SPY, zero DTE.
Yep.
I mean, the numbers
Insane.
are astronomical. I mean, if you're an option guy, I mean, these numbers have to spin your head. And then what I want people to understand out there, which is really important, the liquidity on these options is like something I've never seen. If I turn around to Thomas and say, hey, buy me 1,000 puts. I mean, we're done. Like it was never like that before. So I don't know who they are or what they are, but they're providing incredible liquidity. And right now the system's running really, really good. But you've seen it. I mean, all of us have been around to see market corrections, and I actually think by having all of this option flow, it's going to create more of a move because I don't know when someone sells me 1,000 options, they got to get on, 70,000 common, 100,000 common. And, that I'm one guy. There's 50, 100, 200 people doing this, or maybe thousands. I don't know how they're going to be able to sell that much stock. So I think
Right.
I
And
think
it's
there's a.
just,
I'm
yeah,
sorry.
I was going to say, it's just going to get more, it looks like all of the active weekly names are going to go Monday, Wednesday, Friday at some point. We're doing some zero DTE using flex option ETFs or flex options on single names. But I got to figure at some point you're going to have zero DTE on anything that's active, but certainly Monday, Wednesday, Friday, which just makes things even more interesting.
Oh, it's going to add so much to our P&L when we get that because you can now express your view in a single day. I mean, doing these spreads, let's say, like we talked about Bitcoin, it's trading, let's say 111, and for the day we don't think it's going to be above 112 and a half. You have a 1 day exposure versus, used to be a 3 week, up to a 3 week exposure. Listen, I can't believe they're doing it. I mean, it is just going to have so much stuff out there all over the place. It's amazing. I mean, I have to say that the pickup in liquidity and the pickup in volume it's the most amazing thing I've ever seen. I
So,
never.
Larry, you were on the SIBO floor in 1984. You're 25 years old. Must have seen some crazy stuff, man. You have any good stories? What's the best one? You got to have at least one for us, man. I love this kind of stuff.
Uh, oh my God.
Like, there's too many to
I'm gonna
say.
tell,
It's
I'm gonna
like Michael
tell,
Irvin. Like, no one believes any of his stories, like, but they're all true.
oh, it's very funny you used his name. I think I'm actually gonna be teaching him how to trade. How funny
All
is
right.
that? So anyway, so I'll give you like my first story of being in the business. So I don't know anything about the business. I had a girlfriend whose father was a huge soybean trader. I went to their house when I was in college. I'm like, whatever your dad's doing, I got to do. I don't know what it is. He brings me to the floor of the Board of Trade. It's the coolest thing I've ever seen. I mean, there's
Right.
lights flashing. You don't know what's going on. And I go to work with him. The hours in soybeans back then were 10 to 1. He worked 3 hours a day. He
Right.
he literally was killing it. Okay.
Right.
But he says to me, he goes, listen, he's like, I haven't made money. This is 1984. I haven't made money since 73. He's like, I think you should go learn options and go to the board options exchange. Now, options were fairly new. They came up in they only started with calls in like the mid 70s. So, they introduced puts just before I got there. So I go there, I interview with a guy, I get the job. I don't know from anything. I moved to Chicago. I know one friend, he's at the University of Chicago, and I go to the floor. It's my first day, and I getting trained by his assistant, and he says to me, "Listen, you're gonna get fired every day, but make sure you come back the next day." I don't know. I mean, I didn't know what
That
the.
sounds like me, man, actually.
So
Right.
wait.
Yeah,
So
Pat's the red stapler guy.
oh really? So wait. So I go to work first day. I'm calculating. I don't know. And you got to remember, now it's easy because we're in decimals. Okay. Back then in
Right.
fractions. Okay.
Right.
So if you didn't work with fractions, you couldn't add four fractions together like in a
Right.
second, right?
Right. Like, what's
So
one divided by eight,
oh no,
right?
he was like, "What's 1 1/4, a half, 3/8, and 7/8?" I'm like, "I don't know, four." He's like, "You're a freaking idiot. get the hell out of my office. You're fired.
Oh, that's great, man.
This is the best. I
Nice.
call my mother and I'm like, Mom,
You call
what
your
do I
mother. Oh, this gets better.
do?" I go, what do I do? I got fired, but the guy said, come back the next day. Okay. So she's like, okay, just do what he said. I go back
Oh,
the next
shit,
day.
man.
Now you got to remember, I was the clerk and this is Chicago. So it's an hour earlier. So I'm
Right.
getting in at like 6 in the morning.
Yeah.
The guy is cursing me out, telling me to get out of his office. I come in the next morning. He's like, "Hey, buddy, how was your night last night?" I'm like, "Oh my God!" So, I mean, that was my
Oh.
introduction to the business. So,
Well, we're kind of like
I got-
brothers in arms, I guess, then, bro.
oh, I know. It's, I mean, I got crazy stories, but,
Anytime, man. I'm down. I love this stuff.
did you trade on the floor?
No, I did not, but I love the story.
Oh, my stories are.
With
I mean,
options though, man after my own heart. I'll trade a naked chart, but I'll never trade a naked option.
I love it. Don't do it. You
All
know,
right.
I'll leave you with, I'll tell you one more quick one. So I'm living in Chicago. I'm in the business. It's 1986 going into 1987. And I lived in an apartment and there were 4 guys that were in medical school that were in the building with me that were my good friends. And every month, you got to remember, there was only an expiration once a month. Every month they would sell naked puts on the
Right.
index for
Right.
drinking money or
Right.
spending money. They
Right.
would make 5,000 a month,
Right.
whatever. So I say to my friend Pete, I'm like, Pete, this is 1987, right before the crash. It's the month before the crash. I'm like, Pete, one day, you're going to lose 50 grand on this thing. You're going to get hammered. Okay. Long story short, October comes, crash comes. The guy lost a $500,000. He didn't have the money in the account. The account was deficit.
Oh,
He lost
Right.
$500,000, okay, on a naked put on the day of the crash. So the
Right.
50 I thought he lost was 500. And what was interesting was they went after his family for the money. 'Cause
Oh, jeez.
yeah, but you know what? They actually didn't have to pay. They actually ruled, the court ruled for all of these people that it was undue risk and they didn't
wow.
understand the risk they took. That's why now there's so many disclosures in everything you do. But back then it was like you just signed up. But anyway, that's my naked put story. So
Right.
don't do it. Don't do it.
Got it. All right, fellas.
I've,
Great
I've,
stories, Larry.
All right. It
I've
was
got a great one. I'll tell it later too.
later.
Great
All
having
right.
you.
Thanks. See ya.
Thanks,
Thank you.
All right. Thanks,
Adios.
guys. It was a pleasure.
Thanks
Take care.
again. And thanks for joining us out there on YouTube land. We'll see you again tomorrow, same time.
All right, bye.